If investors had a Hall of Fame, Warren Buffett wouldn't just have a plaque. He'd have an entire wing dedicated to him. He built one of the most powerful conglomerates in modern history, turned a failing textile mill into a trillion-dollar empire, inspired millions of investors around the world, and became one of the richest people alive, all while living in the same modest home, driving himself to McDonald's and paying himself just $100,000 a year. But the story of how Warren Buffett transformed investing forever isn't just about money, it's about philosophy, it's about psychology, it's about making decisions that almost no one else had the courage to make. Today, we dive into Warren Buffett's incredible journey, how he developed his strategy, the philosophies that built his empire, the mistakes he made, and the question every investor is asking now: what happens when Warren Buffett is no longer running Berkshire Hathaway? This is the full story. Section 1. The origin of a money obsession. Warren Buffett didn't become the world's greatest investor by accident. He was obsessed with money from the very beginning. Born in Omaha, Nebraska in 1930, he grew up during the Great Depression. His father, a stockbroker, taught him what instability looked like and how wealth could protect you from it. Buffett made his first investment at age 11. He bought 6 shares of Citi Service Preferred, 3 for himself and 3 for his sister. The price dropped immediately. Most kids would have panicked. Most adults would have panicked. But young Buffett learned something profound. A temporary price drop doesn't change the value of a business. When the stock eventually rebounded, he sold for a small profit. Years later, he'd call that decision one of his biggest mistakes, selling too soon. Because after he sold, the stock soared far higher. It was his first taste of opportunity cost. One of the many mental models he'd master over his lifetime. But Buffett wasn't just interested in stocks. He was fascinated by business itself. He delivered newspapers. He bought used pinball machines and placed them in barbershops. He filed taxes for neighbors. He salvaged golf balls. He flipped Coca-Cola bottles for profit. If there was money to be made, Buffett found a way. And that obsession set him on a path that would change investment history. Section 2. Discovering the Master. Benjamin Graham. By the time Buffett entered college, he already understood business better than most adults. But he wanted to learn from the greatest. That's how he found Benjamin Graham, the father of value investing. Graham taught a radical idea: buy companies for less than they're worth. Be patient. Ignore the crowd. Buffett was hooked. He begged to join Graham's firm, Graham Newman, after graduating from Columbia Business School. And after a year of pestering him with letters, Graham finally hired him. Working with Graham changed everything. Buffett learned about Mr. Market, an emotional, irrational character who offers prices every day. Some days he's euphoric, some days he's depressed. Your job as an investor? Ignore his mood and focus on value. But Buffett didn't just learn Graham's principles. He internalized them so deeply that he started to evolve them. Graham focused on buying companies that were cheap, even if the businesses weren't great. Buffett would soon build something far more powerful. Section 3. Buffett's first empire. The partnership. Years in 1956, Warren returned to Omaha and started his first investment partnership. He had 7 investors and a grand total of $105,000 in capital. But Buffett had an unstoppable advantage. He used Graham's principles with a level of discipline almost no human could match. If Buffett didn't understand a company, he didn't buy it. If the price wasn't right, he didn't buy it. He didn't chase trends. He didn't trust hot stocks. He trusted math, logic, and patience. In 13 years of partnership, Buffett averaged returns of over 30% per year, while the market barely delivered a third of that. That performance was unheard of. He was becoming the young phenomenon of the investment world. But then, he made the move that would define his legacy. Section 4. The accidental masterpiece. Berkshire Hathaway. Buffett didn't set out to build a trillion-dollar conglomerate. He simply bought a cheap textile company in New England called Berkshire Hathaway. It was a disaster of a business. Outdated machines, brutal competition, shrinking profits. Buffett later admitted buying it was one of his biggest mistakes. But what he did with it changed everything. He used Berkshire as a holding company, a vehicle for acquiring businesses he actually believed in. Instead of selling stocks, he bought entire companies. Dairy Queen Geico, BNSF, Railway Fruit of the Loom Seas Candies, Nebraska Furniture Mart. And dozens more, he built a business empire from the ground up, one acquisition at a time. But the real magic wasn't in the companies he bought. It was in the cash they generated. Buffett took that cash and invested it. Berkshire became a compounding machine. This wasn't value investing. This was value building. Section 5. The secret weapon, insurance float. To understand Buffett's genius, you need to understand one concept: float. Insurance companies collect premiums up front. Money they hold until they may eventually pay claims. During that time, the insurer can invest the money. Buffett realized something powerful. If Berkshire could acquire great insurance companies, the float they generated would give him billions of dollars to invest, essentially at no cost. Most investors use borrowed money. Buffett used float. And float doesn't panic. Float doesn't have emotions. Float doesn't need to be paid back tomorrow. It's the perfect investment fuel. That float funded Berkshire's explosive growth, allowed Buffett to buy distressed companies during crashes, and made his long-term compounding strategy unstoppable. Float is Buffett's superpower, one no other investor has matched at his scale. Section 6. What makes Buffett different from everyone else? The reason Buffett outperformed the entire financial industry for decades isn't just that he found cheap stocks. It's that he evolved beyond value investing. He created his own system, built on philosophies that no one else executed as consistently. Here are the core principles that transformed investing forever. 1. Buy businesses, not stocks. Buffett doesn't care about charts or predictions. He studies the company itself, its products, its leadership, its moat, its future cash flow. He buys companies he would be happy to own forever. 2. Moats matter. A moat is a durable competitive advantage. For Coca-Cola, it's brand dominance. For Apple, it's ecosystem lock-in. For American Express, it's loyalty and premium customers. For Geico, it's cost leadership. Buffett looks for businesses that competitors simply cannot replicate. 3. Circle of competence. Buffett only invests in what he truly understands. If he can't explain the business in a paragraph, he avoids it. He says, risk comes from not knowing what you're doing. 4. Be fearful when others are greedy, and greedy when others are fearful. This isn't just a quote, it's his operating system. He buys when panic drives prices down. He waits when euphoria drives prices up. This discipline turned market crashes into opportunities. It's why Buffett thrived while others folded. 5. Patience is a superpower. Buffett once said, "The stock market is a device for transferring money from the impatient to the patient." He rarely sells. He lets compounding do the heavy lifting. Section 7. Buffett's greatest investments. Over decades, Buffett made some of the most legendary investments in history. Let's explore a few. American Express. Buffett bought heavily when Amex was collapsing due to a scandal in the 1960s. He recognized that people still trusted their card. That decision turned into tens of billions in returns. Coca-Cola. He bought Coke in 1988 when the company was struggling with leadership issues. Buffett saw the brand's global potential. His $1.3 billion investment is now worth over $25 billion Geico. He loved Geico so much, he bought it, literally. It became one of Berkshire's greatest cash machines. Bank of America. In 2011, during a financial panic, Buffett negotiated a deal that gave Berkshire massive preferred shares and options at a discount. That single move earned tens of billions. Apple, one of his most surprising investments, but one of his most successful. Apple now represents Berkshire's largest stock holding. Buffett called it, "Probably the best business I know in the world." Section 8. The mistakes that shaped him. Voiceover. Even the greatest investor in history made mistakes, and he openly talks about them. Berkshire Hathaway itself was a mistake. Buying airlines was a mistake. Buying IBM was a mistake. Kraft Heinz didn't work out as expected. But Buffett's strength is his ability to admit mistakes, study them, never repeat them. While other investors hide their failures, Buffett turns them into lessons. It's one of the reasons he earned such massive trust from shareholders. Section 9, the cult of Buffett. Every year, tens of thousands of investors travel to Omaha for Berkshire's annual meeting, known as the Woodstock of capitalism. People fly from every continent. Hotels book out months in advance. Fans line up at 5 a.m. to hear Buffett speak. They aren't just coming for financial advice, they come for wisdom. Buffett shares stories, failures, insights, life lessons, business principles, philosophy. His charisma is subtle but powerful. His humor is sharp, his honesty is rare, and for decades he wasn't alone. Charlie Munger, Buffett's longtime partner, was the philosopher behind the empire. After Munger's passing in 2023, Buffett lost not just a partner, but a piece of Berkshire's soul. But Munger's fingerprints remain on every decision Buffett makes. Section 10, the successor. What happens after Buffett? Voiceover. With Buffett retiring from day-to-day leadership at the end of 2025, the biggest question is, who leads Berkshire Hathaway next? The chosen successor is Greg Abel, the longtime head of Berkshire Hathaway Energy. Abel is smart, disciplined, quiet, strategic. His management style mirrors Buffett's focus on fundamentals, but he isn't Buffett. No one is. The challenge Abel inherits is enormous. A massive $300+ billion cash pile, a changing market dominated by tech, higher interest rates, fewer undervalued opportunities, a shift toward passive investing, and a conglomerate structure that many analysts question in today's world. Still, Buffett insists Berkshire's culture and structure are strong enough to survive beyond him. He will remain chairman. He will remain a guiding force. But the era of Buffett answering questions for 5 hours at annual meetings, that chapter is closing. A new era begins. Section 11, How Warren Buffett Changed Investing Forever. Warren Buffett didn't just beat the market, he reshaped it. He introduced millions to value investing. He proved that patience beats intelligence. He showed that simplicity can outperform complexity. He made long-term thinking cool again. He demonstrated that you don't need fancy offices, exotic strategies, or complex algorithms to become one of the richest people alive. Section 12, Closing, The Buffett Legacy. As Buffett steps back from the company he built, a new chapter begins, not just for Berkshire Hathaway, but for investing itself. But his influence, his philosophy, his approach to life will outlive him. Because Warren Buffett didn't just grow wealth, he grew wisdom. He showed generations of investors that you can win big without shortcuts, without scandals, without ego. His strategy changed how the world invests, and his legacy will change how the world thinks for decades to come.